understand about the management of Maharashtra Seamless. We do have Kushal Bagani, who is the Deputy General Manager at the company, joining in with us to talk about, what is the outlook for FY25? What will be the growth drivers that one should be expecting from the company? Kushal, good afternoon. Thank you so much for joining in with us on ET Now. And Kaushal, I beg your pardon, Kaushal, if you could start by talking about the Q1 numbers, they seem like that has been a bit of an impact, mainly given by the fall in the realization, as well as the preventive maintenance shutdown that one has seen. Would you say the worst is behind for the company? What is the outlook in terms of that? And then, do you think the next 3 quarters of the year would make up for this fall, Kaushal?
Good afternoon. Thank you for inviting. You are right in making the assessment that the worst is behind us. The results that actually were reflected in the first quarter, they were a consolidation of three different factors, all of which happened at the same time. And you rightly pointed out that the preventive maintenance shutdown, the fall in sales realization, and the accounting treatment of inventory, all of these combined led to a lower EBITDA per ton in the first quarter. So if we make a nearer term view, then we can reasonably make that assessment that the worst is behind us. In the past, we've done EBITDA per ton ranging from 12,000 to 25,000 rupees per ton. Unfortunately, due to a combination of these three factors, the EBITDA per ton fell to 9,000 rupees per ton. Earlier, we had given a guidance of 15,000 rupees per ton based on the prevailing order book at that time. And I don't think there is any reason to believe that that will not happen over the course of the year on a blended basis.
Okay, so at least for the near term, the worst is over. But wanted to get a sense from you with respect to the order book as well. The last time we spoke, it was close to around 1,800 odd crores. Has there been any
That's right.
pickup in that since then? And overall, what's been the demand like? Which segment, let's say oil and gas or other segments as well, which is gaining traction right now?
Order book remains upwards of 1,800 crores. When we spoke last, the order book was at 1,820 crores. It still remains at that level. Please bear in mind that all our mills are fully operational at this point in time. So the only conclusion that one should draw is that orders are being replenished on a daily basis and are being executed. There is no problem in terms of demand, and we are getting very good orders from the oil sector. Oil sector is the most profitable sector for us, and more than 50% of our order book is concentrated on two customers. And I think 65 to 70% of our order book is the oil sector order book. Therefore, it is a good position to be in as of now, and we will see how the dispatches and the orders in the rest of the year turn out.
Uh, Kaushal, you did say order book, yes, continuing to see good traction as well. 1,800 plus is where the order book is at right now also. I just want to understand in terms of the demand environment, that is good even from the export side, or is there some sluggishness over there? And because in the past we've seen a bit of a sluggishness, but does that mean that now everything is good in the export market as well and you're seeing a revival? And if yes, then which geographies?
No, that is not the case. Exports remain slow. One of the reasons why exports remain slow is because domestic demand is very good. And then we are given a situation where a trade-off between domestic and export orders has to be taken, and we want to do whatever execution that we can on an order which gives us the highest profitability per ton. Currently, that is in the domestic market. And a data point that you should note is that in March 23, the year ending March 23, our exports were 30% of total dispatches. In year ending March 24, our exports were less than 10% of total dispatches. However, EBITDA per ton has improved in March 24 than it was in March 23. And keeping that parameter in mind and our impetus to enhance profitability, we are not focusing on the export market till we are able to feed our mills with requisite orders and profitably so.
Despite you focusing on profitability and going slow on exports, your margins
Yes.
dipped quite sharply this quarter. It halved to 11% versus 23%. Talk to me about how the
Yes.
full year picture is going to be like. Is it realistic to expect around 5,500, 5,700 crore worth of top line and margins around 15 to 20%?
Margins front, I've already spoken as to the three factors which consolidated themselves in a given quarter, but that will normalize in the forthcoming quarters. And the most important factor was the accounting adjustment that we had to do because stock is valued at lower of cost and net realizable value. And due to fall in billet prices, we had to mark down the inventory. However, that inventory was purchased against some very high value orders which we had. Those orders which were not dispatched in the June quarter on account of the preventive maintenance will be dispatched in the forthcoming quarters, leading to normalization of margins. I think these factors will normalize going forward. However, the factor that will remain for the rest of the year would be some dumping from Chinese players that we are seeing. And that has also been a factor in falling realizations.
Let me just kind of make it a bit more pointed. I understand you're talking about Chinese imports. So, are you expecting any ADD there? And if I can just kind of corner you and ask you 5,500 to 5,700 crore on top line, and when you say margins will normalize, does it mean back to above 20%?
On each of these 3 points, the first is the ADD. There is already an anti-dumping duty. However, in certain segments, when the anti-dumping duty was imposed initially in 2016, those products were not manufactured in India at that point in time. Since then, we've developed those products and Chinese players are able to participate because they are not covered by ADD in those segments. On the second point regarding turnover, we don't give guidance on turnover, but what I can definitely tell you is on the production and dispatches front, I think production and dispatches in FY25 will remain at the level that it was in FY24 because we are in the process of undertaking capital expenditure and the production will only increase once that capital expenditure plans have been fully implemented. On the third point regarding margins, right now we have an order book of 3 to 4 months, and that is what we've always maintained. We believe margins will move from 9,000 rupees per ton, where they are right now, gradually to 15,000 rupees per ton.
Right. Thank you so much, Kaushal, for joining in with us on ET Now, talking to us about the outlook of the company going forward as well. That was the management of Maharashtra Seamless on Right Now, talking about the outlook of the company.
If you like this video, then like, share and subscribe to ET Now.